It is January 13th, 2023, and I'm doing a video on tax relief in the state of Michigan. The governor and the legislative Democrats have been making some headlines with some proposals that they've rolled out. They're proposing to make drastic increases to the Earned Income Tax Credit, also known as the EITC, and repealing what they deem the pension tax, which, as I'll get into later, is a misleading talking point. Maybe before I really dive into what those are and proposals that I'll have that are a better solution for Michigan families, maybe we should talk about how many people their plan would help. So it's a bit tricky to figure out an exact number, but from what I've been reading and researching into, I think it's fair to say about 1.2 million filers in the state of Michigan would benefit from their tax relief. And it's pretty lumpy of who would receive relief and who wouldn't. What I'm going to propose would help all 5 million filers in the state of Michigan, and it would be fair and even across the board. So first, let's talk about the Earned Income Tax Credit, and let's dive right in. So what is the Earned Income Tax Credit? Well, it's a credit administered by the federal government. It has been in place since the 1970s, and it has two stated goals. The first one is to reduce poverty, and the second one is to incentivize work. And I think those are very good goals, and I think we should be trying to accomplish those as well. I give credit where credit's due. Looking into it, I think there is evidence to show that it actually does help reduce poverty to some extent, and that's good. But I guess that just proves that this credit is not completely without merit. I don't think that's enough proof to show that it's great and we should double down on it or triple down on it. The other stated goal of incentivizing work, there is no evidence that I can find anywhere actually shows that it increases either worker productivity or workforce participation. And that's after decades of data. I think it's pretty well proven it's not going to work to increase, to incentivize, I should say, workforce participation. So how does the credit work? Well, there are three different phases. I have this chart here. The first phase, there's a lot of different lines. It's kind of confusing, but you can kind of see in the first stage, they're all kind of going up, this slope. In that first phase, as you're earning more income, you get a matching credit, and then it plateaus when you reach a certain income threshold. Now, this gets confusing because there are different variables that are going to change which line you're at here on the graph. And those are based on your marital status and whether or not you have dependents. So based on those variables, once you reach that first income threshold, you max out. So you stop earning more of a credit the more you work. And then you reach another threshold, and that's when you start seeing the lines come down. So you're kind of coming down this cliff. And then it phases out. So as you earn more income, you get less of a credit. Now, this is very, very confusing, and it leads to the first of two major drawbacks to this credit, and it is a huge error rate. If you look at this chart here, you'll see over time, a roughly 25% error rate is it's pretty constant. A lot of people make mistakes when they're trying to file for this credit, and I think that is this chart here really showed how complicated this tax credit really is. And the IRS lists out what the five biggest reasons are for this high error rate. And they are a child doesn't qualify, more than one person claimed a child, social security number or last name didn't match, married or filed as single head of a household, or lastly, over or underreporting your income or your expenses. So let's give people the benefit of the doubt. I think by and large, majority of those people made an honest mistake because it's very complicated. I could see how it could happen. However, when something's this complicated, there are people who try to take advantage of the system, and there's a lot of fraud. This is a problem because since right now we do a 6% match, whatever someone gets for a credit at the federal level, we just simply give 6% of that. We don't have any oversight over any type of errors or fraud or anything of that nature. So that's a big drawback. That's drawback number one. And I guess I'd ask the question like this: who among us would spend our own money on a program that is so rife with waste? I mean, I can't think of anybody who would put their own money into this, and it doesn't make sense to me to put our state tax dollars into this program even more. The second biggest drawback is that it disincentivizes work. There's a very strong argument for this. So it does so in two ways. First, as you're kind of in phase one and you're climbing up that chart, um, once you have reached whatever threshold you want for your income to support your lifestyle, you have no incentivized. No, you're not incentivized to continue to work. So, for instance, if you want $20,000 is what you need to fulfill your lifestyle, if you actually work, 17 enough hours to get to $17,000, then the credit's going to fill the rest of that gap, and you're not going to work those hours. So it actually would reduce the amount that person would work. The other way that it disincentivizes work is at the phase out when you're coming down that cliff, and that's because people don't want to lose the credit, so they'll stop either working the number of hours or whatever they have to do to be productive to increase their wages. They won't do so. So again, that's a big drawback, and it really is indicates and shows how much this fails at its second stated goal of incentivizing work. So there's a better way to go about achieving these two goals of reducing poverty and incentivizing work, and that's through expanding what we have for our personal exemption. So right now in the state of Michigan for this tax year, it's forecasted that we will have a personal exemption of $5,400. So what does this mean? It means that the first $5,400 that a filer would make is tax-free. And this is a good way of trying to achieve those same goals because it proportionally helps lower wage earners more, and there's relatively no way to fudge the numbers to try to defraud the system or to make those same errors that we see in the EITC. So let's take an example here. Let's say someone's a high wage earner and they earn $100,000. With the credit now, they receive about just over 5% of their income is tax exempt. They don't pay our 4.25% state income tax on it. But then if someone earns, let's say $20,000, they're at the lower wage earners, then they're getting over 25% of their income is tax-free. That's more money in their pockets to support their families and help boost them out of poverty. And it helps get everybody into the workforce. So, what we can do at the state level is we can look at doubling or maybe even tripling that number. And then that way we can achieve those same goals in a way that will help promote growth in the state of Michigan in a fair manner that helps everybody. So next I'll move on to repealing the pension tax as the Democrats are proposing. That's the talking point that they use. It's very misleading. Maybe I'll explain why it's misleading. I guess you could make your own judgment if you think I'm right or not. So the state income tax in Michigan was put in place in 1967. And at that point in time, unions were very, very influential. Still influential, but back then, even more than it is today. And when this income tax went into effect, they were able to exempt retirement income from government pensions. Not really all that fair because that one group of people didn't have to pay income tax, but say you had a pension from a private company like one of the big three automakers, or let's say you had a defined contribution plan, all of that retirement income was subject to the state income tax rate. So fast forward to 2011, Governor Snyder becomes governor, and he wants to have a fair and simple tax structure across the state of Michigan. So what he did was he created a phase-in to have all retirement income types taxed the same. I'm going to talk about this a little bit. I'm not going to go into all the nuts and bolts because it is pretty technical, but I'll try to give a fair assessment overall of how this phase-in worked. So first off, if you were born before 1946, or you had a spouse born before 1946, there was no change to your public funded pension. No change. I mean, those people were very close to retirement if they weren't already retired. So no change pre-1946. Now, between 1946 and 1952, there was a phase-in. So what they did is they increased the personal exemptions, as I talked about earlier, to $20,000 for a single filer, $40,000 for a joint filer. Now, if you're born after 1952, for this third part of this phase-in, there was a 20,000 single, 40,000 joint exemption once you reach the age of 67. And it's important to note that this applied for all forms of income. It could be any type of retirement income, and it could even be earned income if you were still working. So that's how that worked. And I just think it's important to notice that giving a certain tax break or exempting an entire group of people from having to pay an income tax is not really fair. In fact, it's pretty quite clear that this certain group tends to be heavily affiliated with Democrats. Not all of them, but you see a large portion of that constituency it helps the Democrats. So it's not a very fair way of doing it. And I think there's a much better way of offering tax relief for seniors for everybody. And if you look back at what we proposed last year and the governor vetoed, what we did is first off, we lowered the retirement age for everybody down to 62, which is a good way of doing it because you have many people who, once they reach that age, they're eligible for Social Security. They actually retire. It's good to kind of set that number as a good retirement age. The next thing we did is we doubled the exemptions. So it would be 40,000 for a single filer and 80,000 for joint filing. That's a really big number. And if you think, what's the average public retirement pension in the state of Michigan? Well, if you look at the public school system, it's not as much as one would think. It's between $20,000 and $25,000 per individual. So this would cover a large percentage of these retirees' income. And as I keep saying over and over again, it's a fair method that would apply to everybody. So I appreciate all your time to kind of drill into what's being proposed and an alternative plan that would help more people and would be better to help promote growth in the state of Michigan. So I appreciate all your time. So thank you and God bless.